Hi, this is Paul Pennington, and welcome to another episode of Pep Talk. And my very special guest today is Chuck Dannis.
Welcome to Pep Talk, where we discuss the state of Texas real estate market as it relates to property taxes. Here's your host, Paul Pennington.
Hi, my name is Paul Pennington. I'm the president of P.E. Pennington and Company. And it's my great pleasure to have back Chuck Dannis. Thank you for coming. And you and I were just talking. Last time you were here was August of 2022.
Yes.
And so as we sit here today, it's October of 2023. And before we go any further, why don't you give some of your background to the audience? I don't know that we did that the first time.
You did it eloquently last time. Yeah. So I'm by trade a real estate appraiser and consultant, and been doing it literally half a century here in the Dallas-Fort Worth area. I did work a while in Austin, but 95% of that time is right here in Austin. Represent large institutional investors and lenders and owners across the country. I'm with a firm called National Valuation Consultants, and we bill ourselves as the largest privately held appraisal firm in the country. And then, as you know, I've been on the faculty at SMU Cox, and I teach real estate markets and valuation is the name of the course for 36 years.
Wow.
Yeah.
And you used to have a radio show?
I did. I was on the radio. I was telling Ashley, I was on the radio for 20 years almost. Yeah, talking about dirt. That's what I said.
Talking about dirt.
Yeah.
We can talk about dirt today.
Yeah, we can talk about dirt. We were at lunch.
We were. So as we sit here today, anytime you and I get together and there's a camera, the market tanks.
Yep.
So we're down, 470 points today?
Yeah.
Last time it was 500 points.
No, it was 700 points when we went on the
points?
air. And just as we went on the air, I looked over, it was a 400 down. But, good news is I think we're still up 10 or 12, 11% from this time we were on last year. So It's cyclical. We talk about cycles and we talk ups and downs, and not only in the stock market, but certainly in real estate. So long term, we're still up.
So let me kind of go back to our conversation in August of 2022. The Feds had begun raising their rates, and I'm not sure where we were in August of 22.
2.5%.
2.5%. And since that time, the Fed has continued to raise their interest rates to fight inflation. So as we sit here today, we know that the current Fed rate, as we sit here today, is
5.33, something like that. Yep. It's a twofer. It's a double.
And we know that before the end of the year, they've already announced they're more than likely to raise the Fed rate one more time. So let's just say at the end of the year it'll be 5.5. Call it 5.5.
Okay.
So with the increase in the Fed rate, lending rates have responded accordingly. So as we sit here today in October, what is a typical range of lending rates for commercial property? Or does it, I'm sure it varies like for office, but say for multifamily, what's the range today?
Well, all of it's priced off the 10-year Treasury. Not the Fed funds is a short-term rate. It's a daily rate. Fed funds is 5.33, as we just said. But when we went on the air in August of 22, it was the 10-year was 3%, and today it's 4.8%. That's a 60% increase if you think about it in the cost of funds. And you ask about apartments. I think as a rule of thumb, you might say in today's market, it's priced at 180 basis points, 1.8% over the corresponding 10-year Treasury. So that'd be over 6%, which is pretty tough.
If we go into the future and we say there'll be another increase for the end of the year, as of January 1, do you think lending rates will be, for apartments, what range would you?
Well, it should be 6.5% to 7%. You can buy those down, which just like you do in a home mortgage, you can buy those down and try to get it. The mantra today is buyers don't want negative leverage. In other words, they don't want their return on their investment to be lower than what they're paying their lender. And so in terms of pricing real estate, that's called the cap rate, right? It's year one income over your price or your value. And when we were speaking in middle of last year, August 22, let's just say in an apartment, a cap rate might have been 4.5%, but that was against debt at 4.5% or 4%. So now that debt is 6.5% to 7%. That argues for a much higher cap rate.
Just a range that you anticipate this other increase as of the first year. Just it's a guess.
Yeah, I think it's going to go up another 25, 50 basis points. And it depends on whether we go into a recession and incomes start to fall back, income meaning rents on various properties. But, real estate has been repriced since we talked. And when we talked about it in August of 22, you asked me to prognosticate, and I was hesitant, as a good appraiser would be. But I said, yeah, there's going to be some pain in the market. And the question is one, when will they stop raising rates, they being the Fed? And then two, when will that signal to the market that the repricing has stopped, that we've hit a floor? And there's all kinds of pundits and people prognosticating about how much money is on the sidelines. I've seen figures of $250 billion of what we call dry powder sitting on the sidelines today. But we have to get to that bottomish. Everybody's got to believe that the repricing is over. And I think at that time we'll have a good comeback. But whether that's January 1 of 24 or January 1 of 25, I think is the question.
Okay. So if we did that same line of questioning and we went to, would the interest rate, is there a difference between interest rates when you're loaning to multifamily or in industrial?
Yeah, there's agency financing, what they call agency financing, and it's more liquid, I think. But I think that pricing is probably the same in that 150 to 200 basis points over the corresponding 10-year Treasury. And that would be, if we talk about the four food groups, apartment, industrial, retail, and multifamily as the broad four. The first three food groups, I think, are in that 150 to 200 over. When we get to office, it just may not be available, period. Conversations, if you get over $100 million in an office building loan, there's just not any players out there right now for that. So it becomes very difficult as these loans start coming due that were made 5 years ago or even 10 years ago or even 3 years ago. As they start coming due, the question is, how can they refinance?
Let's just talk about the three and put an office over here. If you're going to buy real estate now, okay, you either have to, with these interest rates, right, you either have to get a very good price to buy it. And I guess the other alternative is you have to put in a ton of equity to be able to buy it with these interest rates.
Right.
Are those kind of the two ways you can do it?
Yeah, and there's mezzanine debt, which goes in between the first loan and the equity. The problem is the equity, if the debt's priced at 6 or 6.5, what's the equity got to be priced at? 8, 9, 10, 12. And so if you blend those two, that means cap rates, unless you're thinking, if you're thinking it's just going to be kind of ebb and flow over the next year or two, then our interviews in the marketplace and talking to buyers and sellers and lenders, in some markets like Dallas, Fort Worth, Austin, maybe Houston, and even San Antonio, buyers are willing to take a negative leverage for a year. It used to be when we first started this conversation, they said, yeah, we'll do it for 3 years. We'll be out of it. So that was back down to 2, and now it's a year, 18 months of negative leverage, meaning your cap rate is less than the mortgage loan. So I think you picked January 1, this next 3-4 months is going to be really pivotal in seeing, what happens in the marketplace. We have to have price discovery, and right now we haven't had it.
So I'm just trying to work it out in my mind that if your interest rate is 6 plus, it seems to me the first component's got to be price.
Right.
Is somebody willing to take this price? it seems to me that during the pandemic, it created a real estate market I've never seen in my life. Never seen it. And I think I mentioned it before, where I have retail builders and they would be building something and they'd be 85% complete, no history of how it performed, and they'd have contracts lined
Right.
up. Those days are gone.
Those days are gone.
Those days of just, purchase prices that kept breaking and breaking and breaking and breaking records, that's gone. So now, to me, what this seems right now, with interest rates at 6 or 6.5, whatever it is, we're kind of back to where we might have been 30 years ago. Where this was typical interest rates in these ranges.
Yeah, that's true.
So it just seems to me that buying real estate right now is first of all, you have to have a seller who will recognize we're not in 2021. We're not in that hyper inflationary
21.
place that we're at, where prices were just going to the
And
moon.
free money.
And the interest rate was essentially zero. That's gone.
That's gone.
And so I think right now we're getting back to what it used to be decades ago.
Yeah. Well, the long term, so the 10-year Treasury that we talked about is how you price real estate. The long term, it's 4 and 8 today. The long term average is 4.5. I mean, so I think there is an old saying in economics: you revert to the mean, and so hopefully we'll at least revert back to the mean and get a little bit lower. But I think once it stops and the Fed signals that we're done, and the next step would be down, and you would suspect that interest rates will come down. I mean, the market signals that, because we're in this environment, and not to get too technical, of an inverted yield curve, that short-term rates are higher than long-term rates. And that would portend that cap rates should go down in the future, and people are betting on that. The question is, every time the Fed raises, and every time we have a day like today, and there's oil prices going up, and we have Ukraine, and we have interest rates going up, and then the labor market is all skewed. I mean, we're in the full.
We have a bunch of strikes going on.
And all of that creates hesitation and pullback in the markets. And so, a few months ago, I would argue with some of my friends that I didn't feel like a recession was on the horizon. And I just heard one today that those numbers are now balancing back up, that we are in for a recession because oil prices and all the things that are going on. But GDP came out and it was still positive. GDP is high. Commercial real estate returns are highly correlated to GDP. GDP goes up, commercial real estate prices go up. But now that was the second quarter, and now we're in the third quarter, and the stock market's cratering, and interest rates are skyrocketing. So it's really just indecision that keeps specifically real estate investors on the side. Until we get that bottom, it's going to be a slow market. Transactions in the U.S. are down, commercial real estate, 60-70% across the board.
Let's talk about the class of property that we put to the side, office. So you tell me, I was mentioning to you over lunch that there was an article in the Wall Street Journal, and they were quoting occupancy rates all over the country, and companies are still faced with the issue trying to get people to come to the office, the effects of COVID, and they still want office at home. So when you look at office, what do you see?
A troubled asset for sure, but you have to make sure you have you're describing occupancy versus leased space, because a lot of the occupancy that they tend to grab headlines today is how many people are actually in the office.
Well, there was just an article. I don't know if it was Wall Street Journal, but I read an article. We've seen markets in Dallas where you have leases in place.
Yeah, sure.
And then we saw this huge explosion of sublease. Now we're seeing subleasing of subleasing. That was in the last 2 weeks that article came out. That tells me, yes, these leases are in place, but people aren't there.
Yeah.
And when these leases expire, that's a real problem.
It is a real problem. And that's what I was kind of getting back to. And one of the questions when we were appraising and working on an office building, one of the questions we're mandated to ask is, okay, you lease 100,000 square feet and you used to have 1,000 people here. how many are actually coming into the office, and then that parlays into what you think they're going to renew at. So it's actual physical occupancy versus leased occupancy. And I did look, and I use, when I talk statistics and stuff like that, I'm using CoStar data, which is kind of a recognized industry standard, but just across the board, vacancy rates, and this would be the least vacancy rates, across the boards in the 4 major markets in Texas are up 25, 20%, 34%. So it is a problem. It's not getting any better. And as you and I were talking about at lunch, capital will find a way to deploy. And maybe when we went through the 80s and had high vacancies, and then the Great Recession and all that kind of stuff, and even when COVID hit and all the buildings were vacant, it just finds a way to deploy. And maybe that deploy is that buildings are going to be scraped. Some of these 80, we have all those buildings in downtown Dallas that were built in the 80s.
Well, hold that thought. When we talk about office buildings, is the future different for Class A, Class B, and Class C?
Most of the studies, and there have been studies come out, it's really not even A anymore. It's A+, AA. I think I mentioned that Bank of America just signed a huge lease, 250,000 square foot in a brand new building. And you have to believe that the rents in that brand new building could be 3, maybe 4 times more than what they're paying in downtown Dallas right now. So that just shows you that, yes, there is demand for that. But I also saw that Fountain Place, one of our beautiful buildings in downtown Dallas, put a pickleball court in one of the floors. And so,
really?
Yeah, and so, I don't know how far that takes you, but it shows you 2 things. There's a demand for pickleball, and then that there's no demand for office space. But the question is that is really a difficult pricing. Nobody really knows on office buildings.
Are you saying that A+, that they have, their future seems to be more secure than just A, B, C? Right?
Yeah, absolutely, absolutely. And I think that's what everybody's talking about. However, I say that, and then, we went through COVID and everybody said you can't give away a mall. Retail's dead. Nobody's going to shop. Now retail is almost the darling of the industry.
But how about malls?
Have you been to North Park Mall? My gosh.
North Park is, you can't hurt it.
Yeah, it's like
hurt it.
It's the number 2 mall in the country. I think
Right.
Fashion Island and Newport is number 1. But it's a fortress
I never
mall.
go there, but my wife told me we're going to go to such and such restaurant, and we went.
It was just packed.
Oh yeah, we had to valet park
Yeah.
to get in.
Yeah, it's just crazy. So the good ones, and that's what I said. Capital will find a way to fix all the problems, and some of those malls won't make it. Look at Valley View Mall, Mid Park, and it's going to, scraped, gone down. It's no longer
Willow
there.
Bend's going to get redeveloped into
Totally lifestyle.
right.
Yeah, have offices and residential and stuff. And so capital will figure out that way. I don't think it's all pickleball courts, but some of these buildings are just going to have to go away.
We talked to repurposing, and you said that there's an event coming up, and one of the speakers is going to be someone who repurposes office buildings into multifamily.
Exactly. The January meeting of the North Dallas Chamber of Commerce,
Right.
their annual real estate conference. And Jonas Woods, shout out to an SMUer, started with Hillwood Perot's company and did Victory down there. But he's repurposing 3 buildings down there. But he's also building the giant brand new high-rise in downtown Dallas. So he's, in one hand, he's saying, oh my gosh, I got to take office buildings and repurpose them.
Right.
He's taken 3 giant buildings. And then on the other hand, he said, but I'm going to go ahead and build the AA, AAA best building in town. So, like I said, capital finds its way, and real estate is a capital-intense market. So we'll just figure it out. But it'll be painful for some people.
So as we sit here, what is today? October 4th?
Third.
3rd? What if you just had a bag full of money, and they said to you, go make a real estate investment, just say in greater DFW, what class or what type of property would you buy? And you had to buy it.
And I had to buy. I had to deploy the company, the cash. I think, for me, it sounds a little early. You know, no offense.
So your answer is you wouldn't buy anything.
Yeah, I might. I can get 5% in a money market.
You get more than that.
Yeah, or whatever. And it used to be that in COVID era, in that time, you only got 0.5%, so you couldn't keep capital in there. I mean, you'd never get any kind of hurdles or anything. So it might be. I think as you and I talked again at lunchtime, a little pregame show. There's going to be some pain coming up in the market, and that pain is in the form of loans coming due. Lots of loans were made in the last 3 to 5 years at interest rates that typically will double.
Isn't it in the trillions? Like it's a
I think it's
of loans that are.
Yes, I believe so, and it just depends on how you calculate it and the maturity and whatever. But if you just the public real estate market is about $1.2 billion right now. The private real estate market measured by institutions is another $1.2 billion or $3 billion. However, those are not overly trillion. Sorry, they're not overly leveraged. Most like in the private market of the institutions, they may have 25% leverage. In the public markets, I think it's more like 34%, something like that. So it's not like, so theoretically you could drop 70% and you wouldn't have a loan come due. But it's still, that's just part of the market. It's still, a lot of these apartment deals were made with interest-only notes. And when those come due, it was a double
rush.
Yeah.
I mean, people, I have clients that made fortunes.
Oh yeah,
made fortunes.
Yeah,
and on deals, and then I talk to them all the time, and I go, well, they recently tried to sell another deal, and they had projected they would get this, and they're not going to get this. So now the retail builders, so now they have to run it. Because they can't get it.
Yeah, and from the last, I looked at 3 studies, research papers, one called RCA, Real Capital Analytics, and then another looked at CoStar, which publishes, and looked at NAREIT, which is the public markets, and all of them hover around, since the last time we spoke, the overall market's down 10 or 12% at this moment in time. I think that's probably going to increase a little bit. But one of these, this RCA study, it's down 10%, but if you would have bought 10 years ago, it's up, I'm going to look right here, 81%. So, you bought 10 years ago and you lose 10%. And if the values have gone down 10% this year, good real estate, and we talked about this last time, good real estate probably produced a 5% cash return to you. Maybe more, but it should be in that 5. So you lost 5% equity. I mean, you lost almost that today in the stock market, right? So, you buy, and we talked about this last time, you buy commercial real estate, unless you're a real developer or operator, you buy for cash flow and hold it for a while and go through these cycles like this. But debt is going to be the killer. And you couldn't argue, and you talked about many of your friends, you couldn't argue with somebody 3 years ago for not grabbing a 3% loan. I mean, and going out and doing anything you can. That what you now argue against is that it should have been a 30-year note instead, or at least a 10-year note, not a 3 or a 5-year note, because it's coming due.
So let's talk about something different. When you look at the 4 types of property, and again, let's put office over to the side. So we're talking about retail, industrial, and multifamily. What are you seeing in income? What are the income trends? In greater, greater DFW or Texas as a whole?
I've got kind of the 4 food groups mentioned, and retail is the only one that kind of stayed flat. Apartment rents are either flat or down. Industrial rents are down. And that's all just a pullback. You lower rents to get your occupancy up. So if you see softening in occupancy, you start lowering your rents. And before, there was no downside to occupancy. I mean, it was just so much demand. We talked, we absorbed 1 billion square feet the last time we were here in industrial. So now it's really kind of softened in all of those markets, but it's not catastrophic stuff. I don't think in any of the markets I looked at it was catastrophic looks. I'm looking at some of the rents. I mean, Rents in Austin, retail rents up 10%, Dallas 5%, up Houston 2%, and San Antonio up 5%. So the retail, and like I said, you couldn't give a retail away during COVID, right? I mean,
Right.
nobody was going to go
Right.
shopping.
A lot of tenants weren't paying.
Yeah, tenants wouldn't pay, and they got
Well, they
free.
couldn't.
Yeah, they couldn't pay, and they had free rent. So then looking at the industrial market, rents up in Austin 5%, huge increases in now this is year over year, so we don't really, this is the second quarter, so we're
Okay.
3 months into it. Almost, and this is quoted rents up almost 30% in Dallas, Houston 9%, and San Antonio 6%. Everything that I've heard, however, now that's just in that's second quarter to second quarter. We're now 3 months almost into or the fourth month of after that everything is pulled back.
Okay.
But you still got that huge increase to settle in on.
What about multifamily?
Multifamily is the one that had a little bit of a problem in Austin. Rents down 4%.
That's unbelievable in Austin, truly.
Yeah, and that they're the highest rents in Texas, up
Right.
over
Yeah.
$1,700 a unit. Down about 1% in Dallas-Fort Worth, 1% in Houston, and up 1% in Houston, and down about 2% in San Antonio.
So that same statement could apply to these, that they've pulled back
Yes,
more
yes,
since these.
yes. That's kind of that's the anecdotal stuff that you hear from apartment, and certainly the big apartment managers, the Greystars and the JPIs and the Lincolns and all that have that on a daily basis and track that. But statistically, I mean, I think that's everybody's getting a little now. Today, I think is the first day that first part of the month, October. Yeah, was when student loan, you got to start repaying your student loans, and it's going to take a bunch of cash out of the market. So it's just it's part of a cycle, right?
So if you look into the future, and you and I won't meet again for 1 year, so where do you think we're going to be in, say, October? The real estate market in Texas, October of 2024, where are we going to be?
I think we're going to be better off than we are today.
You do?
I do. I think the market will settle in. I don't know about just total vacancy rates and all. That might settle in and get a little lower, but transactional volume and leasing volume, because I think whatever hesitancy is out there in the market, that's my hope, is that within the next 9 months, everything settles in. The Fed, they do one more, maybe they do one more by the end of the year, January. And then they say, we're done. So everybody kind of scoots, and then they start meeting in dark rooms in big office buildings and start deploying capital again.
When we talk about Texas, and when we spoke in August of 2022, if we were a country, we're the 9th largest economy, and today we are the 8th largest economy. And I was at a conference, and they were talking about, population growth in Texas, where we're going, and so on and so forth. And you and I have talked about this triangle, which is DFW to greater San Antonio, Austin, over to Houston and back up, that doesn't exist anywhere else. There was a futurist was making a prediction that the most populous 5 cities, or four out of the most populous 5 cities in the United States, will be in Texas.
That's a big deal.
And
it just starts to merge, like places in
that's
California,
in the
New
future,
Jersey, and Philadelphia.
Right.
No, exactly.
I mean, the population of greater DFW is bigger than New York City right now.
Yeah.
It's big. And I think for whatever reasons, I don't know that people think of Texas like that all the activities going on here.
And that's why the Texas Triangle is fun to talk about, and it was created by some guys over at SMU, economists at the Bush Library. But it's going to merge. I mean, the freeway systems, and it's a pretty tight little area. And they're different. What's kind of cool is that they're all different cultures, right? Mm-hmm. I mean, Austin's certainly on its own, and then San Antonio's a different market. Houston and Dallas are vie for, the most artistic and all that kind of stuff. But it creates a great environment for people to move here.
Yeah.
And we still got open space in the middle, right?
Right.
It's getting expensive, but it's open space.
So I'm gonna end this this podcast with your predictions. A year from now, we're going to be better off. If someone had just given you all this money and told you to buy an asset, you would have told, in any property type, you would have told them, I'm waiting for a better price. Is that about it?
And that better price could happen at 3 o'clock today, though. I mean, it wasn't, so I think I would wait for a little pricing, I hate to say pricing correction. I don't know if it's going to be a correction, just some pricing intelligence and to do that. And I said you could still park the money and get a decent return, but I think I would be planning on deploying it by January. So I'm just saying, as of today, I'm not so sure I would buy an apartment.
So if you were given the money, you would take the money and say, I'm not going to buy it today, but I will buy it between now and, say, the end of the year.
Exactly. Or I could buy it tomorrow if that opportunity came up, because I think there is going to be stress. And so the capital that always makes money in times like this is the fast trigger pull. People, they can make a decision quickly and deploy capital and then finance it later, buy it for cash and that kind of thing. So
I mean, a question we didn't talk about, do you think foreclosures are going to go up?
I think they have to. Yeah, I think they have to. It's just the nature of the beast. And maybe they're structured foreclosure. I mean, we're already seeing them, right? But like I mentioned, I think across the country, transactions are down 60 or 70%. So there's going to be,
so your prediction's pretty safe. If we're down 70%, a year from now,
it's got to be more. I mean, it's got to be more than that. Is that fair?
That's fair. That's fair. Well, as usual, really appreciate you coming.
My pleasure. Sure.
There's so much knowledge that you bring to the table. Half a century.
Half a century. I know. I started real young, though. I started in grade school.
Half a century. Half a century. So thank you very much.
My pleasure,
and
Paul.
thank all of you for watching.
Thank you.